Hello, everyone. Welcome back. So we are continuing with the question that we're doing. So if you haven't seen the previous video, it's better to check that because we're basically going to be using some of the information already covered there, and I won't be explaining sort of like the same things, but I will try my best. But for the sake of time, so if you haven't seen the previous video, I've linked it so that you can go and check that, and so we can be able to continue with this question. So the last video covers 1.2, 1.1, and 1.2, and now on 1.3. And please make sure that you remember to subscribe, like, share, comment, all of those things to make sure that you support the channel. And if there's anything that you would like to see in the channel in the future, I will do read the comments. And even this video, I'm doing it because someone posted a comment that they would like to see um, the June 2024 paper. For now, I'm still doing paper one, but I will be doing more videos that will be covering topics that are on paper two. All right, without wasting any more time, let's get into this question. So the question basically is we need to basically complete the statement of financial position. And it says that there's some amounts that are provided already in the answer book. So basically, this is the answer book. This is how it looks like. And you can also see the answer book right here that you got some amounts in the asset section, but no amounts really in the equity and liabilities section. So let's get straight into it. So starting off with our assets, so that's pretty much done. So we're going to now move into inventory. So we know that what is included in inventory will include in inventory the trading stock as well as the consumable stores on hand. So let's try and find that information and then see how we can use it then. So information A doesn't give much in terms of inventory. Information B has a list of balances, and we have a balance here for trading stock amounting to 1,064,200. Let's also look then if there's any information that affects or some consumable stores on hand which you can find, but we'll see. So let's see. Okay, cool. So yes, there is one information that does affect, and this is information that is relating to information C, specifically number two, because we made a donation in this question. And remember how we treated that donation in the income statement. So we don't need to make any calculations now. It's just taking that amount we got for donations in the income statement and basically subtract it against our trading stock, and we have no other inventory items that are available. So let's see, the donations amounted to 40,200. And so what you're going to do then for the inventory, we are going to say, well, we have an inventory balance that we have been given, which is 1,064,200. So 1,064,200. And then we want to subtract the donations that were made because they were not yet recorded. So then we subtract those donations, and that will give us that gives us 1,024,000 in respect of inventories. Next, we'll move into trade and other receivables. So trade and other receivables, remember that it includes many things. So it includes debtors, and then you subtract provision for bad debts, and then you need to add your prepaid expenses, add your accrued incomes. Yeah, and those are some of the things. And then potentially there could be like a SARS income tax situation. But I did look at the SARS income tax situation as I was reading the question. It's going to be a liability. Just a quick glance to it, by the way. You can see here that the tax expense for the year is 351,000, and then you're given SARS income tax provisional payments, which is 322,800. So you basically need to make a further payment towards taxes, so that's going to be a liability. Doesn't affect trade and other receivables. Now let's get into the things that actually do affect trade and other receivables. So firstly, we're given net trade debtors. Now the fact that they gave us net trade debtors, it means that there's already a subtraction of provision for bad debts, because when you have net trade debtors, it means that you took your debtors control and subtracted your provision for bad debts. So in this case, we don't need to work out any provision for bad debts, but we're going to start and open a bracket and say the amount that you're going to be starting with is 744, 900. And let me also just make sure that I got it right. Yes, 744,900. All right, cool. Now let's think about some of the things that we come across as we're doing the income statement. Now, the first one that I do remember was the fact that we did rent. Now, this rent was not yet received, but it should have been received. So there was 1 month of rent that was not received. So if it was not received and it is an income, well, that suggests that in this case, we have a situation of an accrued income. There's an income that we've earned because we rented out the premises, which is yet to receive the money. And so that would add to our trade and other receivables. An alternate case could have been in a case where we received rent for more than the current financial period. Then in that case, you'd have a liability for income received in advance. But you can see here that it is not the case. The other thing that we need to consider for trade and other receivables is prepaid expenses. And remember, from the calculation we did for directors' fees, there was one director that was paid 104,000 in advance. So that also then adds into our trade and other receivables. And then let's look at the other information then that maybe we have not yet considered. So A, B, not so much. C, I think we've went through that information, and then we have the income tax information, which we're happy with. Oh, and then there's this information here. They say transfer the debtor's ledger's balance to creditor's ledger. So it says a debtor with a debit balance of 8,400 in the debtor's ledger must still be transferred to his creditor's ledger. So most people sometimes struggle to understand this. So basically, you have someone that is a debtor, right? Meaning that they owe you money, right? So they have a debit balance, meaning that when they have a debit balance and it's a debtor, that's the money that the business owes. So that's the money that the person owes to the business. Now, it says that we must transfer that account to the creditor's ledger. Now, this can happen in a situation like this. So if you owe someone money and then at the same time you owe them money, because you can see here that this person is in a debtor's ledger and they're also in the creditor's ledger at the same time. So this is a situation where maybe you buy on credit from someone and they also buy on credit from you. So sometimes you deal with them as a debtor, sometimes you deal with them as a creditor. So in this case, we're basically going to take this 8,400 that they owe, and then we're going to use it to basically offset against the amount that you owe them. So in other words, then we basically take out what you owe them, so we no longer owe them. So in other words, sorry, not we no longer owe them, but they no longer owe the 8,400. We've basically taken the amount they owe us and then we set it off against the amount that we owe them. So this is going to decrease our trade and other receivables, and also it's going to decrease our trade and other payables when we get to that point, because we're taking an amount. So basically the entries that are involved here are this: debit creditors control. When you debit creditors control, it means your creditors are decreasing, and then so debit creditors control and credit debtors control. Debtors control is decreasing, so you credit it. Creditors control is decreasing, and so you debit it, because remember that assets, you debit them when they increase, you credit them when they decrease. But with liabilities, you debit them when they decrease, and then you credit them when they increase. So that's what we do with that 8,400. And please make sure that you are very attentive to situations like that, because that's something that sometimes can throw people off. And then we have the loan and the other things. So now there isn't much left. All right. So then in this case, we then would have our trade and other receivables equaling 867,800. Now that we got our trade and other receivables, we can basically work out our total for current assets. And the total for current assets then is going to work out to 3,848,020. And then after that, we can add up our current assets along with our current liabilities. And that will give us 14,225,500. Okay. Then we move to equity and liabilities. All right, so equity and liabilities. So we have our ordinary share capital, and then we got our retained income, and then we got all of these things. Now I'll fill them out, and then we're just basically going to just be working these out. So let's start with ordinary share capital, see if we can be able to find this information. So ordinary share capital, there was this information here that is on share capital and dividends. So it says share capital and dividends. So on 1 March, we had 2,120,000 shares in issue, but at the end of the year, we have 1,890,000 shares in issue. Okay, so these shares are in issue, but let's look at the transaction that happened before that. 30th of June, there were 230,000 shares that were repurchased, and the average issue price of the shares on the date was R5.90. And there hasn't been a transaction since that, so there was no additional shares issued. Now, this makes it a little bit easier to calculate because if when you do a share repurchase, then it means that whatever shares remain are basically at the average issue price until you have another share issue. So in this case, there hasn't been another share issue. So that R5.90 average issue price would still be relevant for the shares that remain after you have repurchased the 230,000 shares. So it's going to be simple. We're just going to take the 1,890,000 and then we're going to multiply by R5.90. So 1,890,000 multiplied by 5.9, that gives us 11,151,000. Next is retained income. Now with retained income, remember that when we do the note, we start with the balance at the beginning of the year, we add profit after tax, we subtract the portion of the repurchase of shares that is above the average issue price, and then we subtract our dividends. Now, let's see if we got that information, by the way. So what is the balance of retained earnings at the beginning of the year? Well, it's a question mark. We don't know. And then also something we also don't know here is the fact that we know these shares, they had a average issue price of R5.90, but we don't know how much they were repurchased for. They could have been repurchased for R7, for R10. So in this case, we don't have enough to be able to work out our retained earnings at the end of the year because of those mainly two things. Because remember that if the average issue price is R5.90 and then we buy back the shares for R6.90, for example, we'll take that R1 multiply by the number of shares, and that will be the amount that we offset against our retained earnings. So in this case, we don't have that amount, and so we're not able to work out retained earnings, and so that's something that maybe we're going to come back for if everything else goes right. So let's then move into the next part of this statement of financial position and look at the loan at PTA Bank. So let's look at the information relating to the loan. So what do they say? They say extract from the loan statement from PTA Bank. So balance of the loan on 1 March, so at the start of the year, was 1,400,000, and then at the end of the year, it's 1,004,000. Okay, and so these repayments that are being asked during the year, and they say including interest, doesn't matter as much in terms of including interest or not. But basically, we can see here because we're basically looking for the capital portion of the loan when we do this one. So in terms of the capital portion of the loan, well, in terms of the capital portion of the loan, we can see that the business made a repayment equaling 396,000 during the year. And then what do they say about the next financial year? Because now we need to also look at what is short-term part of this loan. They said all entries for repayments and interest have been made. It says directors expect to maintain the capital repayments made this year. So whatever capital repayment we made this year, same applies in the next year. The capital balance of our loan at the beginning of the year, 1,400,000. Capital balance at the end of the year, 1,004,000. Difference between the two, 396,000. So then the short-term portion of the loan, meaning that the amount payable within the next financial year or within the next 12 months, which makes it a current liability, is going to be 396,000. And then we're going to go like this. So we're going to say loan PTA bank. So we're going to say 1,004,000, and then we're going to say minus 396,000. And then let me make the box here so that we can get our total. So we get 608,000, and so that would be the non-current liabilities. And shortly after that, you basically take that 396,000 into our current liabilities, right? So there's 396,000, and then let's look at the other liabilities. Now, remember that when it comes to trade and other payables, we also spoke about that 8,400, that this is the money that the debtor was owing, and then instead of saying pay all of that money back, we basically take that money that they owe and say subtract from the money that we owe you, as you're a creditor. So there's that minus 8,400 in anything that you're going to be doing. Okay, so then let's look for some of the things that affect trade and other payables. And if you can remember them, we have the creditors control. We then would have income received in advance. We then have accrued expenses. And then, we have creditors for salaries and other things. But in this case, I think the ones that we maybe need to look out for is the income received in advance, and then also the accrued expenses. Let's see then our creditors control balance that has been given. I think yes, it's given 518,950. So we're going to start off with the balance 518,950. 950, and then obviously we subtract the 8,400, which I've already explained, and then after that we need to look for income received in advance. I don't think we have an income received in advance because we just look at our income statement that we're correcting here. We actually had accrued income instead of income received in advance. But for the audit fees, remember that the audit fees were still owing at the end of the financial year. And so those audit fees will constitute an accrued expense. And those audit fees were for 45,600. So we add that into our trade and other receivables. And then I think that is it, because we've looked at pretty much all the information. There wasn't nothing else. All right, so that's 556, 150, and then shareholders for dividends. Well, shareholders for dividends is basically our final dividend. So let's look for our final dividend. So let's go find that information on the shares and dividends. Well, interim dividends were not declared during the financial year, all right? But then there's a final dividend of 25 cents per share to all shares in the share register. Well, on the 29th of February 2024, the shares that are in the register are 1,890,000. So you're going to multiply that by 25 cents. So you're going to say 1,890,000 multiplied by 25 cents, so that's 0.25. And then that is going to give us our shareholders for dividends amounting to 472,500. And then lastly, we have the SARS income tax. And then the SARS income tax, we're basically going to work it out this way. Basically need to get our tax expense for the year, which was given 351,000. And then we subtract the provisional payments of 322,800. So there we go. So you're going to say 351,000 minus 322,800. Let's double check the number. Yes, 322,800. And then close the bracket. And that then gives us an income tax balance of SARS income tax balance of 28,200. And therefore we can be able now to add our current liabilities. So if we add up all our current liabilities, we then would get 1,452,850. Okay, and so what we then need to do is then find a way to get a balancing figure, because remember that um, assets are equal to equity plus liabilities. So we have our total assets. So we're going to take that balance of total assets and put it as our total equity and liabilities. And then from this balance, we're going to subtract the 1,452,850, subtract the 608,000, so that it can give us a total of our shareholders' equity. So there we go. So we're going to say 14 million minus the 1.4 million, and then minus the 608,000. And so that gives us a total of 12,164,650 in respect to ordinary shareholders equity. All right. Cool. So then now we can basically use the retained income as a balancing figure. So it's a balancing figure in this case. So how we're going to do this, we're just going to say, well, 12 million minus the 11 million. And so that gives us just 1,013,650. And I think that pretty much concludes the statement of financial position. I think it was fairly straightforward. There were some maybe other things like that 8,400, which typically confuses people, but hopefully with the explanation that I gave, you understand it a little bit better. Yes, so nothing else but to ask again that you guys make sure you subscribe and comment what you want to see next in the channel. We definitely take those into account, and I shall see you in the next video. Cheers for now.